makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, SpaceX has officially filed for its IPO, aiming to raise $75 billion in the biggest listing ever. The mega-IPO race is just getting started, as Bloomberg also understands that Anthropic has picked Morgan Stanley and Goldman Sachs to lead its IPO after filing confidentially for its own listing. Now, in a moment, we'll be joined by Arend, Kapteyn, Global Head of Economics and Strategy Research at UBS Investment Bank. But first, Matt Bloxham from Bloomberg Intelligence joins us. Matt, every day we talk about SpaceX. Every day we talk about these mega IPOs. I mean, is this a battle, actually, of the mega IPOs, SpaceX and Anthropic? Does it make a meaningful difference on who comes out first?
It does, although I think probably SpaceX a little bit of a different bucket to Anthropic and OpenAI. I think there definitely is more of a battle between OpenAI and Anthropic, and clearly Anthropic is winning that right now. I think it does make sense to kind of be out there asking for money sooner rather than later, because you never quite know what the market's going to do. You know, we're seeing this huge volatility, particularly in AI-related names, and I think if things don't go well with the SpaceX IPO and or the Anthropic IPO, then maybe that for OpenAI that means they either have to accept a much lower multiple than they wanted, or kind of shrink the amount of capital they're raising. And as we know, these companies are all desperately hungry for capital to keep funding their midterm growth.
So, I mean, Broadcom, and this is kind of having an impact on markets at large. Broadcom results disappointed investors. What does that mean for the broader AI momentum?
Yeah, I mean, I actually think that the print itself in isolation was a good one, and it's positive for the AI story. You know, when in isolation, their AI revenues are up 143% year on year, and their guide for the next quarter is up over 200% year on year. So actually, in terms of executing against their AI pivot, they're doing really well. It's just that market expectations got a bit ahead of where they're going to come out. And if you look at it, it's about $1 billion of revenue we're talking about next quarter. They're guiding to $16 billion of AI revenue. The market was looking for a bit over 17. And who knows, they may well actually end up hitting 17 or more. But they're just trying to give a realistic expectation of where growth is. But it's a very healthy growth number. And I think it does underpin the fact that there's a huge amount of demand for AI chips out there.
Matt, I mean, indulge me, because I'm a little bit obsessed with SpaceX, and I've been going through, some of the prospectus. I mean, it's incredible, like 1 million people on Mars,
yeah,
and that gives them an extra bonus. I mean, is there any chance that the IPO is not successful because some of the metrics are, frankly, a little bit weird?
Yeah. I guess it depends how you measure success. Clearly, the banks are going to be very sensitive to making sure that there's enough left on the table for incremental demand. I think the fact that you're seeing the relaxation in the index inclusion rules probably gives you that kind of demand tailwind once it's listed. My personal view is that the next data points we see are going to be positive in terms of this kind of mid to long term story for the business. It is almost kind of fantastical, what they're planning to do on a kind of multi-decade view. Yeah. And there's clearly lots of engineering and commercial challenges they need to address to get there. But I think in the short term, the data points we get are going to be positive against that story.
It's so fascinating, and I can't take my eyes off it. Matt, thank you so much. Matt Bloxham from Bloomberg Intelligence. Now we're joined by Arend, Kapteyn from UBS Investment Bank. Arend, I mean, it feels like we're having these two conversations, which is one on AI and these big IPOs. And I know AI has been largely supporting a lot of the markets. But then there's inflation, there's, concerns about the Strait of Hormuz. Like, when do the two worlds collide?
Yeah, so it looks like for now at these oil price levels, they're sort of canceling out almost perfectly, right? So, and in fact, what's sort of surprising to me is that the stress we saw in March is actually less severe in May when you look at Asia, supply chain disruption, et cetera. And so now part of that is because the tailwind from AI, it's not only large, but it's quite recent, right? So if you look at sort of the run up in what's happening in sort of Asia, export data, et cetera, the charts are just completely parabolic, right? And so when you start to sort of add up all the countries that are in the AI supply chain, you get to more than half of global GDP. And when you look at the trade in AI, it's about double the energy trade. And when you look at the memory prices versus oil prices, they've gone up 8 times faster than oil prices. So you start to sort of see the contours of why we have this big offset. Of course, what that hides is then sort of the distribution. So you're getting this aggregate strength in the U.S., Korea, Taiwan, and in equity markets. But you still, I think, are also seeing the pain from the higher energy prices, the supply chain disruption, et cetera. So we have sort of, I think, just distributional stress, but aggregate sort of resilience. I think that's sort of how I characterize it for now, right? And then we have to sort of see where the Middle East goes. So, we're still depleting these inventories at alarming rates. I think the conviction levels have gone down on when that becomes sort of binding, when you start to sort of see these prices respond to that. I think as a function of time, and what you're seeing, governments say, for instance, in Asia, is, next month is the month we run out. And then, a month later, it's like, no, next month it's the month they run out, right? And so I think that the cliff effect is sort of getting pushed out. The data is not behaving in a way that suggests we're about to see some material deterioration, right? And so that, I think, is enhancing confidence in the markets that, okay, that means we have more time to come to some kind of ceasefire agreement.
Arend, I mean, on AI, do you believe in the power transformation at this level? So we're spending billions and trillions. What if the technology needs new data centers with new equipment? I mean, we're kind of throwing everything at it now in a technology that's still advancing very quickly.
Yeah, so what I find fascinating is that, so last year, did 500 billion, 550 or so in the U.S. on CapEx. Let's say we're at, 800-900 this year, so delta 400. That 400 delta is sort of driving everything in the world, right? So the 400 billion, which is about 1.25% of GDP, is giving you about, 20% of GDP in extra equity valuations, which is then driving the bulk of U.S. consumption, is giving you now, I think, the bulk of sort of the delta in global trade growth, which is 80% AI now. So it's all the same dollar, right? So it's amazing the multiplier effect of, I think, that CapEx build-out. Now, when you look at the projections of how much more that has to go, we have several years of that to come, right? Now, I think there's a difference then between markets and sort of national accounts in the way, the economy is measured. So it will become hard to sustain what we're currently seeing in the growth contribution, because it's not about the levels but about the change. So if we sort of flatline at $1 trillion a year, then over time that means we get less GDP contribution. Now, I still think that'll be confirmation that this is progressing and we're, technology is improving, and I think the markets will be fine. But the tailwinds we're seeing now are probably pretty close to a peak in terms of the deltas that it's generating.
And so Odd Lots, which is one of my favorite podcasts, actually also spoke to Goldman Sachs chief executive David Solomon, and they were asking whether these big mega IPOs, what they meant, because there are so many coming all at once. Take a listen.
I do think we've created a regulatory structure and a market structure that really makes it unattractive to go public until you have to. The reason these companies are going public now is because they have to. They have capital needs that are so voracious that it is not prudent for them to try to do 100% of it in the private market and not have a public currency. It's just not prudent. And that's why I think you're going to see a bunch of these companies go public, because they actually need the capital.
Well, you can watch the full conversation on the Odd Lots podcast. And Arend, I think for our conversation is that if they have to, does it change fundamentally our economies?
You mean the amount of borrowing that they need to do? Or
yeah, I mean, the markets, I mean, these big IPOs, we've never really lived through it. I don't know how that translates into your world.
Yeah, so I mean, that's the equity side. Of course, they're also going to borrow $250 billion, right? I think there's plenty of appetite to actually fund it, right? I think the markets would not be going up if there was no appetite, I think, to fund it. So I'm not sort of concerned about it. I am concerned about the distributional sort of the skew or the narrowness we now have, particularly in U.S. growth. I mean, that does create a vulnerability. But the funny thing is, like, it also makes it really hard right now for the U.S. to go into recession. So if you try to sort of, we're running our models, trying to figure out, at what level of energy disruption would the economy break. And basically, the economy cannot break if the equity market doesn't go down, right? So, and if 90% of the equity market is AI, and that is driving, basically, 80, 90% of your consumption of the top 20%, and you have AI capex, then you're really sort of disrupting what's left, and what's left is really small. So now that is not good if you're an average citizen, or you're worried about your job, or you're at the bottom end of the income distribution, and you're becoming delinquent. But at least for the market in aggregate, there's just an incredible level of resilience, I think, that comes with that AI build out. So the risk then is that, something unexpected happens, that there's suddenly competition out of China where, things are much cheaper, potentially, equally good models, and then you start to question the sustainability of the profit margins, and you have a rethink about the valuations. But you would really need to do damage. You would need the market to correct on sort of a sustained basis by quite a lot, right? It's not enough to have a wobble where the market goes down, goes straight back up. That doesn't do anything. So, no. And I don't think anybody I speak to on the client side sort of believes that that's that likely right now, right? So there's always nervousness, but I don't think people think we're in the closing or end innings of this build out. I think we're sort of the early middle innings, and so this has more to run.
And Arend, you were talking about the Strait of Hormuz and actually the price of oil. You're not that worried about inflation because you're pushing back expectations for a Fed cut to what next year, 27?
Yeah. So what we're actually, we had it in December. We've now pushed it to March, and that is a function of inflation. So we're a bit like the frog that's getting boiled. Like every month, the inflation kept going higher because you're just rolling this backward dated oil curve is just rolling into our forecast. So every month there's no resolution. We add another month of sort of elevated gasoline prices. And so that is, if you put that into the Fed models, what that's telling them to do right now is to hike. Now, they don't want to do that. I think they want to look through that. But if you look at the same models, by the time you get to March next year, the model's telling them to cut. And so basically what we're saying is, look, provided that inflation doesn't get materially worse from here, and provided that the labor market sort of goes sideways, then they just do nothing. And then they get to March next year. And then the window opens up for Kevin Warsh, I think, to start arguing for some easing. But that's, for now, I think that's very clearly off the table.
So you wouldn't see one or two hikes and then cut quickly after that?
That makes no sense to me. I think the only scenario in which you would hike is one where unemployment starts to sort of drift lower, despite the fact that we have all this distributional weakness and so then it's very uncomfortable because then basically you're starting to miss on both sides of your mandate potentially, right? And then you have to sort of respond. Now, when I look at the labor market data, it's still a bit of a mixed bag, and it really doesn't look that great, right? If you had not had the 20 basis point decline in labor force participation, unemployment would be at 4.7. I look at the beige book. Basically, there's no improvement in the employment data. Even the job openings report we had a couple of days ago, sort of weird, where vacancies go up, but then the quits are low, and then the hiring rate is super low, and so this is not a labor market that is looking very healthy. And so, provided it stays that way,
AI, or is it really the functionality?
I think it's so. If you look at the Challenger data, which has layoff announcement data, a quarter of all the layoffs is now attributed to AI. That was 0 a year ago. Okay, so there's definitely an element, I think, of AI creeping. I think certainly into wage formation, confidence. You see it in the Michigan survey. But, the Challenger data is like 5% of the overall labor flow. So I don't think we really know. I think we're seeing the beginnings of it. I don't yet think it is driving sort of the flows, which are, much, much larger.
And I don't know whether, the ECB, look, we're pricing in something happening this month. Is the Bank of England much trickier?
I think they're going to be much slower to respond, right? So the ECB now looks baked in. I think the tricky thing with all these central bank curves is that I think you have clarity about, I think, the next meeting, right? And then everything beyond that is completely energy dependent, right? So right now I look at these curves and I say, look, there's really, I don't think the Bank of England is anywhere close to hiking, right? So we think the next move is a cut. We think it's February of next year. But of course, that could all change if we see some sudden escalation in energy prices. The shock becomes bigger. They start to worry about second round effects. But for now, if you mark to market, I think where the economy is and where they are, I think we are multiple meetings away from them doing anything, right? So I think the Bank of England wants to be patient. Their economy is in a weaker position, I think, going into this than the Eurozone was. Whereas the ECB, I think, is just starting from a different starting point. And I think they're running more of a 2022 playbook, I think, than the Bank of England wants to run right now. And so, so it looks like June is certainly baked in. And then beyond that, if they can go in September, we'll have to wait and see what happens in the Middle East.
Arend, thank you so much for joining us. Arend Kapteyn, they're a global head of economics and strategy research at UBS Investment Bank. Now, coming up, the U.S. says Israel and Lebanon have agreed to a conditional ceasefire. We'll have all of the details next, and this is Bloomberg. Well, the former UK Health Secretary, Wes Streeting, says he's not enthusiastic about a, quote, coronation if there's a change of leadership in the Labour Party. Now, he's indicated that he would go head-to-head with the mayor of Greater Manchester, Andy Burnham, in a race which could see the UK with another new Prime Minister. Well, I sat down with Streeting at South by Southwest London.
I think Andy will win in Makerfield, when none of us, Andy included, taking it for granted. I think it comes back to this fundamental point, though, which is I can see Andy's strengths. I think he needs to be tested. I think his ideas need to be tested, and so do mine. And I'm probably a rare thing in the Labour Party. I'm a monarchist, but this is one coronation that I'm not enthusiastic about. I think you need a debate. I think you need a battle of ideas. He needs to set out his stall. I need to set out mine. There may be other people. There may be women. God forbid the Labour Party might have a woman leader for the first time in our history, and we've got any number of brilliant women in the cabinet, outside the cabinet, who might want to put themselves forward. And that's the sort of debate we should have.
So if you're not stepping aside, is there anything that you would find wrong with what Andy Burnham is offering the country?
I understand why Andy talks about a north-south divide in this country, and I think that there are real challenges of place and geography. There's no doubt about that. And there is a concentration of power and wealth and opportunity in London and the southeast. The big divide in this country is not north and south. It is rich and poor. It is those who have opportunity and those who do not. It is the haves and the have-nots. That is what is fueling so much of the rising tide of populism we're seeing. And one of the things that the voters that we've lost to both Reform and the Greens have in common is that sense of economic insecurity.
Well, that was the former UK Health Secretary, Wes Streeting, who resigned from his cabinet position last month and is now expected to challenge Keir Starmer for the Labour leadership. Now, the US says Israel and Lebanon have agreed to a ceasefire if Hezbollah also stops fighting. Now, there's been no immediate indication whether Hezbollah has accepted the terms of the deal. Meanwhile, the Republican-led House has voted to halt the war with Iran, reflecting growing concerns within the president's own party ahead of congressional elections. Now, for more, Bloomberg's Abir Abu Omar joins us from Dubai. Abir, thank you for joining us. So, first of all, how likely is it that Hezbollah will agree to the terms of the ceasefire?
Good morning, Fran. So, look, I mean, it's worthy to note that Hezbollah has not taken an active part in the negotiations yesterday between Lebanese officials and their Israeli counterparts. Now, those negotiations happened brokered by Washington. And what we came out of that with was that Lebanon had said that, and Israel also had said, that it will stop hostilities with the condition that Hezbollah stops its attacks against northern Israel. Now, earlier in the week, President Trump had said that he'd spoken to high representative from the Iran-backed militia in Lebanon, and they had indicated to him that they were willing to stop the hostilities with Israel. So we tend to believe that Hezbollah has the incentive to stop the hostilities, especially if we're talking about a broader agreement between Iran, the U.S. and Israel to reach that interim deal that we've been talking about over the past couple of months that would enable the unblocking of the Strait of Hormuz, the extension of the ceasefire for 60 days, and then reaching the other concessions. Now, Lebanon, Fran, has emerged as one of the sticking points that Iran was not willing to compromise on. So yesterday proved a little bit of a tilt in a positive direction, but no indication, no response yet from Hezbollah as of today.
Abir, what's the impact of the U.S. House vote for President Trump?
Look, I mean, he's under a lot of pressure domestically. Obviously, we saw a resolution that was passed by both the House and the Senate that would have President Trump rethink the war in Iran. He could obviously veto that, but it just shows the amount of pressure he's under in the United States with surging oil prices, crude products, gasoline prices in the United States. So the U.S. also is incentivized to put an end to this and open the Strait of Hormuz, Francine.
Abir, thank you so much. Abir Abu Omar there in Dubai. Now, Bloomberg also understands that Ukraine's key European allies are working on plans to engage Russia and Ukraine in negotiations to end the war. Now, sources say the allies see a shift in momentum, strengthening President Volodymyr Zelensky's position. Well, let's bring in Bloomberg's Anthony Halpin. Anthony, what do we know about this diplomatic effort?
Yes, it's the big three, as you say, the UK, France and Germany, deciding that there may well be a window of opportunity for them to join with Ukraine and try and engage with Vladimir Putin in negotiations to look for a way out of this war. I think they're assessing that perhaps Russia's position is weaker now than it was a few months ago. And at the same time, the US has stepped back because of what's going on in the Middle East. And that's creating an opportunity for Europe perhaps to fill the vacuum and step in and try to find a way out. It has to be said that they haven't had their place at the negotiating table for years. They've been sidelined, particularly by the Trump-led negotiations in the last 16 months or so. And they're looking for a way really that makes them more relevant and to get them into the negotiating table and to find a way that helps Kiev to reach an agreement with Putin.
Anthony, Ukraine has carried out a significant drone attack on St. Petersburg just before President Putin is due to appear. So is he likely to engage with this latest peace effort?
That's something we'll be watching for today. He's due to meet with foreign media chiefs later today in St. Petersburg. As you say, Ukraine made clear that life is not going on as normal in Russia, despite the Kremlin's efforts to present it that way to foreign investors. The drone attack got a lot of attention in St. Petersburg yesterday. Putin himself has said that it's not Europe that is refusing, it's not Russia that's refusing to engage with Europe, but Europe in the past hasn't been willing to engage with Russia. It's not clear that he's ready to take up this new initiative, but that's one key thing that we'll be watching for today.
Anthony, where's China in all of this? I remember one of my highlights actually in the last 6 months was speaking to the U.S. NATO ambassador. And he told me at the time, like 5 months ago, that with one phone call, China could stop Russia's invasion of Ukraine.
Yes, it's certainly the case that Russia is increasingly dependent on China economically because of the sanctions that the West have imposed on Russia. And China has certainly been unwilling to step back from that support. At the same time, they don't want to be cast as the country that's the deciding factor in the outcome of this war. So I don't think we can expect too much change in the Russia-China relationship. China says it wants to see this war brought to an end. It's certainly stood on terms like territorial integrity and national sovereignty. It hasn't backed Russia's claims on territory that is internationally recognized as Ukraine. But it also, in some ways, serves China's interest for the West to be consumed by the conflict in Ukraine because it distracts from paying attention to what might be going on with Taiwan.
Anthony, thank you so much. Anthony Halpin there with the very latest, of course, on Russia, Ukraine. Coming up, jitters on private credit markets after a big redemption warning. Well, Blair Jacobson, co-president of Ares Management, joins us next. This is Bloomberg. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Mega IPOs in focus. Elon Musk says SpaceX aims to raise $75 billion in the biggest stock market debut in history. Bloomberg also learns that Anthropic has lined up banks to lead work on its IPO. The AI rally stalls. A disappointing outlook from chipmaker Broadcom hits sentiment. Plus, the U.S. says Israel and Lebanon have agreed to a ceasefire if Hezbollah stops attacks. Now, there are renewed jitters in private credit markets after a big redemption warning. Shares of the big alternative asset managers fell yesterday after Cliffwater's flagship private credit fund reported even larger requests than in the first quarter. Now, let's discuss the markets and, of course, the future with Blair Jacobson. He's co-president of Ares Management. Blair, thank you so much for joining us. Look, I know there's a lot in private equities and private markets and private credit. What do you think is the pain threshold that we're seeing now and that we'll see in the next couple of quarters?
Well, thanks, Francine. It's great to be here with you. We're seeing a real disconnect between many of the headlines that are being reported and what we're actually seeing in our portfolios. If you think about it, we get signals from 3,000 companies around the world. And what are they telling us? They're growing 8 to 12% per year. We're credit investors, so we look very closely at their statistics. They're trending in the right direction. And there's a lot of discussion and anxiety about distress. We're not seeing it. In fact, when we look at non-accrual rates, which is a prelude for potential defaults and losses, it's lower than what we've seen historically.
But Blair, so why is that? Again, if you have a mismatch into, is it the quality of certain firms or the quality of investment in certain private markets compared to what you're invested in? Because there's something that's going on. You can't tell me that, it's all rosy.
What I would say is if you think about the broader backdrop, the macro situation, yes, there's volatility. We're thinking a lot about inflation, oil prices, and rates. But overall, GDP is growing. We'll grow 2% in the U.S. Europe, UK will grow 0.5% to 1% this year. We're not seeing major distress in the liquid markets for loans and bonds. Even if you look at the big bank earnings, they've telegraphed that charge-off rates for consumer loans, credit cards, C&I loans are actually going down. So I think the broader macro picture is a tailwind for many of these businesses, and it's probably better than what the headlines would suggest.
So there's a large amount of dry powder in the industry, and it's dry powder that's been built up over time. I mean, at some point, does it have to be started to be handed back to LPs, or having some of the tough conversations about what happens next?
So for institutional funds, usually dry powder is available for 4 or 5 years, which tends to be the right amount of time to put it to work. And most managers can then invest through the cycle. What we're seeing today is actually our deployment has been strong. Okay. Again, we have a positive macroeconomic backdrop. And in fact, some of the trends that you speak a lot about on your show around what's going on in the wealth channel, the retail channel, means that less capital is coming into the industry, which means less competition. And when there's less competition, we can actually charge higher interest rates, have slightly more conservative loans and conservative documentation. So we've seen globally deployment has been pretty positive. And there are also some counter-cyclical elements to deployment. When there's nervousness in the markets, that can be good for our special situations business, which had a big fundraise this year, and our secondaries business.
Where do you expect the most deals to come from, sector-wise, but also in terms of countries?
Sure. What we've seen is that U.S. is always the fundamental backdrop to most global markets. It's motoring ahead. It's the biggest market. Europe's a bit patchy geography by geography. Again, growth is a bit slower. It's more highly regulated. We're seeing Asia pick up also in a meaningful way.
Are data centers overdone?
So let's spend a minute on the digital trend. It's something I personally spend a lot of time with as well. Firstly, we're big believers in this trend. We're all using more data each and every day in our personal lives and our corporate lives. The hyperscalers keep increasing their CapEx projections, $600 billion this year, now it's $700 billion. All of that will require more data. When you look at data centers today, the demand is actually exceeding supply, and that's a great dynamic. So industry forecasts that $2 trillion of investment will be needed in the next 5 years for data centers. But that's the broad trend, and we don't invest in the broad trend. What we're looking for are specific assets. And we have a view that if you invest in data centers from a development perspective in major metropolitan areas that are more focused on cloud than AI learning models, and also have very significant 15, 20-year contracts and leases with investment-grade hyperscaler clients, that's a great place to be.
And this is what, across the world? Or again, I mean, it seems that everything that happens in the U.S. and gets rolled out.
So it's interesting if we look at our platform, we actually started investing in Japan first. Okay. In Tokyo and Osaka, great markets. We're now active in East London in the Docklands. We have assets just south of Washington, D.C. in Northern Virginia, and Sao Paulo in Brazil. Again, we like to focus on primary markets where the supply-demand is favorable rather than secondary or tertiary markets.
We spent a lot of time there on this show and actually on Bloomberg TV at large talking about these mega-IPOs. I'm a little bit obsessed with SpaceX to try and understand exactly what happens next. Then we have Anthropic. I mean, does that change the nature of the public markets? Does it also kind of matter to your world?
Yeah, it's a great question. I think we're seeing this opening of the floodgates to these very large mega IPOs that'll take place in the coming weeks and months. But when we look at the overall trend and take a step back at most businesses, there's a definite trend for businesses to be private. The number of companies on the major stock exchanges in the world keeps declining. The number of companies that are private to begin with also are tending to want to stay private for longer. There's so much capital available to fund their business plans through private equity, private credit, infrastructure, et cetera, that I think they want to invest for the long term, which, as you know, is difficult when you're a public company.
So do you see, with these mega IPOs, does it move some of the smaller IPOs to secondary markets? And so would they think actually of going private? Or
it certainly could. So, for example, some of the smaller public companies that are listed, maybe they don't trade much, maybe they don't have much float, maybe it's hard for them to get additional equity capital to fulfill their growth ambitions. That's why focusing more on private markets for them could be a great option.
So we talk a lot about, these inflationary pressures. And at the moment, especially in the U.S., they seem to be canceled out thanks to the boom on AI. Do you worry about rates going up?
So you have to think about where we are. So rates are down around 200 basis points from their highs. And even when we talk about higher for longer, we're still at what we believe is a mathematically comfortable position for our companies. By the way, we just saw how our companies behave when rates were a lot higher. They made it through. The other thing I would say for most of private credit is we invest in floating rate assets, which means if rates are a little bit higher, our investors make a higher return.
We're starting to see, some of the second quarter requests to exit semi-liquid private credit funds coming in. I guess managers are also imposing some of the new rules or lower withdrawal, limits. How worried are you about the sustained retail investor retreat for private credit firms?
This is another topic that's very much in the news. Our firm's view is that wealth is not broken. Okay. In fact, our wealth business will grow this year. We've said this publicly. We have 8 products, 2 of which are focused on private credit in the U.S. Those are the ones that are under the microscope. But our non-traded REITs are growing, infrastructure growing rapidly. European private credit hasn't really come over those concerns. That's growing, sports, entertainment, et cetera. And I've probably had dozens of meetings with these types of investors. They understand that in order to gain access to institutional quality loans and investments that are illiquid, they need to be in a structure that reflects that. So I think their viewpoint is they are performing well. Again, these underlying funds are meeting what we guided investors to expect. That's high single-digit, double-digit returns, similar levels of yield. And as long as that continues, we think that there's going to be a very bright future for wealth products.
Rating agencies start to now review some of the credit worthiness of BDCs. Is that something that institutional investors, will it make them more risk averse?
So when we think about institutional investors, and again, I spend so much of my time speaking to them around the globe from sitting here in London, I would say they're a lot less concerned about how private credit is moving. They're more looking at what's the next opportunity to focus on. And rating agencies will take their view based on the data that they have. That might impact borrowing costs here and there a little bit. But again, I would encourage you and your viewers to really focus on the fundamentals of how the companies are doing. That's certainly what the institutions are doing. They're continuing to back these types of funds. We're seeing in our own fundraising results too.
I mean, is there something that will change in terms of that relationship, in the next couple of years?
I think when we look at what institutions need, whether they are corporate pension plans, public pension plans, sovereign wealth funds, insurance companies, they have growing liabilities that need asset returns. And if we can continue to generate these types of returns in the future, again, we think that the fundraising will continue. And it's been very, very stable despite a lot of disruption in the world over the past few years. Our firm's had record fundraising for 2 years in a row. We had a great first quarter. We said we think this year will be another record for us. And a lot of that is based on institutional support.
Thank you so much for joining us. That was Blair Jacobson. They're the co-president of Ares Management, with a thoughtful and good interview on where the market goes next in private. Coming up, why regulators are also increasingly scrutinizing ties between insurers and private markets. We'll speak to the head of Europe's insurance watchdog. That's coming up next, and this is Bloomberg.
I think you're going to see, and Alphabet is the first one to make this decision, I think you're going to see a bunch of them fund a bunch of it with debt, but also raise more equity, because they're starting to think about, okay, what does this look like? It's one thing, what does it look like this year, but what does it look like over the next 5 years? How much capital do we need? How much debt? If you get it wrong, if you totally rely on debt and you get it wrong, you will really regret if you wind up having a downside scenario that's tougher than you expected. We didn't win this in the last 6 months. We won this over the last 20 years.
Wow.
The decision wasn't made. The decision wasn't made until the last 6 months. And there's a lot of things that the team did over the last 6 months that contributed to the ultimate result, which, by the way, now we have to execute. But this is a cumulative effort of lots and lots of people over 20 years. And we first, as a firm, we first met Elon Musk. And the person that first was responsible for covering him was a guy named Stuart Bernstein, who was doing a bunch of stuff around, kind of green energy. And he and his brother had Solar City. And that's where we first connected with Elon. I do think we've created a regulatory structure and a market structure that really makes it unattractive to go public until you have to. The reason these companies are going public now is because they have to. They have capital needs that are so voracious that it is not prudent for them to try to do 100% of it in the private market and not have a public currency. It's just not prudent. And that's why I think you're going to see a bunch of these companies go public, because they actually need the capital. It's interesting. I've advised companies for years, and at one point 25 years ago, I actually ran the equity capital markets business at Goldman Sachs. That was a job I had early in my career in Goldman Sachs. And I used to say to companies, there are a few reasons to go public. You need the capital. You need the currency. You have to create liquidity for, early investors. But all the other stuff that people talk about is really not critical. We have a lot of things going on in the macro with the war, with the oil shock, supply chains, inflation getting stickier, that are going to have an effect. And the market may absorb all that differently than it's absorbing it at the moment. At the moment, it's kind of brushing it aside.
And a reminder, you can watch the full conversation on one of my favorite podcasts, Odd Lots. Now, increasingly complex ties between insurers and private markets have led to more regulatory scrutiny. In the U.S., Treasury Secretary Scott Bessent recently met with insurance regulators to talk about their exposure to private credit. It's also something that Europe's insurance watchdog, EIOPA, is looking into. Now, the body says that over the past decade, private equity firms have shown a growing interest in acquiring European insurance firms. Now, we're joined by Petra Hielkema, the chairperson of the European Insurance and Occupational Pensions Authority. Thank you so much for joining us. I mean, for me, this is the Apollo model, which actually has been doing really well since it started. And so other companies are saying, well, I want to do the same. Could you, with private equity firms increasingly interested in buying insurers, why are you wary of such deals? And good morning. Thank you for joining us.
Well, thank you for having me, Francine. It's a pleasure to be here. And I hope you can see, as a good supervisor, I don't look worried. I look at risk. And what are the risks? What do we see happening in the EU market? And let's make that distinction between, on the one hand, ownership by private equity of insurance firms, and then investment in equity, private equity by insurers. Now, the ownership has come up since the last decades. In the last decade, we've seen ownership going to now 27 firms, which frankly is only 2.4% of the total market, which in itself is not worrying. It's 260 billion assets under management, which is not material. No. But we should not stop there. We need to also think of EU as 27 member states. And if we look at that way, we see that a few member states actually have a representation, have private equity funded ownerships of over 10%. And this is indeed indeed where supervisors need to scrutinize a bit more.
But is it fair to say that this is definitely a trend that started in the US and that's now permeating or creeping more into Europe? And why do you see that?
I would say that, first of all, it's definitely a trend that started in the US and to a certain extent in UK that has now caught the eye of many. So what can we do next? EU is not that developed, so why not EU? So fair question. In the numbers, we do not yet see that happening. So it's a very steady state already for the last 2 years. And I think there are several reasons for that. But first of all, if you want to move into an EU market with that model, there's two differences you need to consider. One important difference is that you need to match to the life portfolio in EU, which is mostly life with guarantee, with a certain lapse risk, whereas the business so far is based on annuities. And so that is something I would say you need to manage. It's not impossible, but it's something to consider. So,
no, go ahead.
No, and so the other differences we currently see is that most of the investments then made also by private equity backed insurance firms in more private credit is still in mortgages and real estate, whereas we see also in the US that it is part of financing the AI boom that we currently see. So I think these are two considerations that you need to take on board, but for sure we're monitoring this because we do see a lot of interest, explorations in the market. Shall we come to EU? And I think it will.
So what's been the feedback from the industry so far? I guess there's a lot more clarity at the moment on how you're thinking of this. So does it entice more buyers or actually does it scare private equity off?
I would say that currently it's really in the exploration phase. What are the possibilities in the EU market? And that is welcome. I think private credit can bring innovation. It brings access to new capital. We need that in the EU. But it should come, I think, with a reasonable understanding of the new risks that it brings, be it liquidity risk, be it credit risk, be it simply the opacity that comes often with it, and the need for transparency and clear valuation to understand not so much who's the owner of the insurer, but who's the owner of the risk.
So studies, I understand, have shown that insurers actually owned by private equity also tend to invest more in private credit. So how much is too much private credit for an insurer?
Well, I would say there is not per se a certain limit that we have, but we have a lot of tools within the toolbox of supervision, which is Solvency II in EU. And the most important one, I would say, is the prudent person principle. And the prudent person principle says, first of all, if you invest in assets, you need to be able to identify, measure, manage, and report the risks. Yeah. So this is where transparency data is essential. And the second is that you need to do that in a way that you take on board the interest of the people you invest for, which is the individual citizens, and we're often talking about pensions here.
Do you think there's an understanding, a sufficient grasp of the risks that they're taking, and how are, I guess, losses in this asset class evolving?
I would say it depends. Credit was bank business, let's be honest. And so if you start to move into this business, you need to step up your knowledge. You need to be able to probability given default, loss given default, and the probability of default. These models you need to develop. You need to have the data for that. You need to have the competence for that. At the same time, you need to have a clear understanding of how your liabilities, the liquidity risk, the liquidity of those liabilities, the needs there, but also the credit risk that you run, the liquidity risk that you run, how that matches with the liabilities. Why? Because if the markets become volatile, and they tend to do that these days, you want to be sure that liabilities and assets move in a matched way, and there is not an increased response in the market because matching wasn't done properly. And this is precisely why we as supervisors are monitoring that very carefully.
Are there any specific insurers that give you cause for concern because of their risk exposure or their involvement with private markets?
Well, let's say that, I can never discuss individual insurers, but we have individual markets where we see the concentration already of this type of activity being larger than the EU average. And here, for sure, as the EU supervisor, we talk to the national supervisors to make sure they understand. Meanwhile, I would say we're not reacting, we're preventing in a way by publishing a supervisory statement, explaining also to other EU member states supervisors what they need to do when this activity starts to happen in their market, what to look for, how to address it, learning from the others that already have more experience.
But is it, I mean, we talk a lot about software companies and the fact that they could actually be disrupted by AI in a very meaningful way. Is this your biggest concern right now? So that companies invested in that space?
Yeah. So currently, if you look at total assets in EU, 10.5 trillion, of that 5% is private credit at the moment, only 5%. And within that 5%, 80% is real estate and mortgages. So my answer is no. We do not see that in that way currently in EU market today. So we're really saying we need to be ready for the future, much more looking at other markets than being concerned about the risks today manifesting itself.
But how difficult is it for a regulator or supervisor to look at the disruption from AI and actually the risks there that could be, in certain cases, I imagine, systemic?
Well, it keeps us on our toes, first of all, and which is good, and we need to work with it as well. And so I think a lot of it is about coordination, international and within EU, on what we see and how we deal with that knowledge. And mostly, and this is where systemic risk happens, it's understanding the interconnectedness and through the opaqueness. So less opaqueness helps to understand the connections that are possibly there. Systemic risk often comes up by slowly interconnection growing, not everyone seeing it, and then when risks happen, everyone moving in the same direction, which is not a good direction. So we need to be on top of that.
Thank you so much for joining us today. That was, of course, Petra Hielkema, the chairperson of the European Insurance and Occupational Pensions Authority. Now, Bloomberg understands some members of the Glazer family, we're talking football, are debating whether to sell their stake in Manchester United Football Club after more than 20 years of ownership. Now, with more details, Bloomberg's Tiwa Adebayo is here. Tiwa, we're all obsessed. We're all football mad because of the World Cup. So there are, we understand, so Bloomberg Scoop, there are internal discussions. What do we actually know about the Glazer family?
Well, that's right, Francine. A Bloomberg exclusive today. There are these initial talks about whether or not to exit from Manchester United for the Glazer family. In terms of the family itself, they're worth about $10 billion. They've got interest in other sports teams like the Tampa Bay Buccaneers. But these are just initial talks, and there are said to be some members of the family that are against this, and you'd need their support if a sale were to take place. But this is really crucial because that 20-year tenure for the Glazer family at Manchester United is one of the longest in English football history. This is also quite a crucial time for Manchester United. There's talks about upgrading the famous Old Trafford Stadium. That could cost billions of dollars, but it's also something that a big football club needs. We've seen that happen with the likes of Tottenham Hotspur recently. And, of course, we should mention, sorry to any Man United fans, they've had some mixed performances recently, got rid of a manager this season. So a crucial time for the club and for the company as well.
So how much interest would there be if these shares are offered for sale?
Well, the last time that there was a sale like this talked about in 1998, we had the likes of Rupert Murdoch interested in Manchester United. So there's likely to be a lot of interest both on the Middle Eastern side. We've seen the success of the Qatari sports investment arm of their sovereign wealth fund with PSG. They've had great success there. And also the likes of other wealthy US families. The Kroenkes at Arsenal have had, again, good success there. So we'll see quite a lot of interest, but it's likely to come at quite a steep price. Interest in M&As like these has been growing recently. So whoever gets to own this club, if there is indeed a sale, will have to pay quite a lot of money for it.
Tiwa, thank you so much. Great reporting there. And, of course, the Bloomberg Scoop, Tiwa Adebayo, on the latest with the Glazers. Now, if you're a terminal user, you can also watch Bloomberg MLive's Money and Macro event at 5 p.m. London time. I'm not going to miss it because it's going to be really good. And this is under the umbrella of finding value in an AI world. So that's the theme. Of course, it features the anchors from the opening trade. So that's a definite bonus for me as well. Use the function LiveGo, LIVGo, to tune in. Up next, Bloomberg Brief, and this is Bloomberg.